Banks play a crucial role in managing finances, facilitating transactions, and supporting economic growth. However, U.S. banks operate under a different regulatory and structural framework compared to their international counterparts. From interest rates to customer service, many factors distinguish American banks from banks in Europe, Asia, and other parts of the world. In this video, we explore the top 10 key differences between U.S. banks and international banks. 1. Regulatory environment. U.S. banks are regulated by multiple agencies, including the Federal Reserve, the Office of the Comptroller of the Currency, OCC, and the Federal Deposit Insurance Corporation, FDIC. In contrast, international banks are governed by their respective national regulators and, in some cases, by regional authorities like the European Central Bank, ECB, for Eurozone banks. The regulatory differences impact how banks manage risk and serve customers. 2. Deposit insurance limits. The FDIC insures deposits in U.S. banks up to $250,000 per account holder. However, international banks have different deposit insurance limits, often depending on local laws. For example, in the European Union, deposit protection is typically capped at €100,000 per depositor. Some countries offer higher or lower limits, affecting the level of security customers have for their savings. 3. Banking fees and account minimums. U.S. banks often charge higher fees for checking accounts, overdrafts, and wire transfers compared to many international banks. In some European and Asian countries, basic banking services are often free or have lower fees. Additionally, many U.S. banks require minimum balances to avoid maintenance fees, whereas international banks, particularly in countries with strong consumer protections, may have fewer such requirements. 4. Interest rates on savings accounts. Interest rates on savings accounts in the U.S. are generally lower compared to many international banks. In countries like Switzerland, Germany, and Japan, interest rates fluctuate based on economic conditions, and some have even implemented negative interest rates. Meanwhile, emerging markets sometimes offer significantly higher interest rates to attract deposits. 5. Credit and loan approval process. U.S. banks heavily rely on credit scores, such as FICO scores, to approve loans, credit cards, and mortgages. International banks may use different criteria, such as income verification, employment history, or government records. For example, in the UK, a broader range of financial history is considered, while in some Asian countries, social and business connections can influence creditworthiness. 6. Global banking presence. Many U.S. banks, such as J.P. Morgan Chase, Citibank, and Bank of America, have a strong global presence. However, some international banks, like HSBC, UK, BNP Paribas, France, and ICBC, China, operate on an even larger global scale. The structure and reach of banks differ, with some focusing on domestic markets while others dominate international banking. 7. Digital banking adoption. The U.S. banking system has been slower in adopting some digital banking trends compared to countries in Europe and Asia. In China, for example, mobile banking and payment platforms like WeChat Pay and Alipay dominate transactions. European banks also offer more seamless digital banking experiences, with widespread use of contactless payments and instant money transfers. 8. Currency exchange and foreign transactions. U.S. banks often charge high fees for foreign transactions and currency exchanges. International banks in Europe and Asia may offer more competitive exchange rates, and in some cases, accounts in multiple currencies. This makes international banks more attractive to global businesses and frequent travelers. 9. Customer service and accessibility. International banks often provide multilingual customer support to cater to diverse client bases, while U.S. banks primarily operate in English. Additionally, some European and Asian banks offer extended hours or even 24/7 in-person banking, whereas U.S. banks typically have shorter hours and rely more on ATMs and online banking for after-hours service. 10. Banking culture and consumer rights. In many countries, consumer protections in banking are stronger than in the U.S. For example, the European Union enforces strict rules on data privacy, such as GDPR, and transparent fee structures. In contrast, U.S. banks may have more complex fee disclosures and fewer protections regarding financial data usage. U.S. banks and international banks operate under different regulations, fee structures, and customer service models. While U.S. banks offer strong financial stability and global reach, international banks often provide better digital banking experiences, lower fees, and more competitive interest rates. Understanding these differences can help customers and businesses choose the best banking solutions based on their needs.